First of all, I would like to take a moment to thank the organizing committee for giving us the opportunity to share our research areas with distinguished researchers all over the world. It's a pity that we are not in Poland this year, but at least I hope that everyone is safe home and we can explore these new technologies of virtual conferences. And I hope that you enjoy this as I do. So our paper that we have conducted with Professor Kosmidou, who is also with us today, and Professor Theodosiou, also Dr. Saba from Cyprus. This paper is on electricity pricing, as the title reveals, and a small introduction related to the broad picture, what is going on. The electricity prices all over the world are settled on power exchanges, and those power exchanges and the different markets that we see in the different energy exchanges are quite volatile, with a plethora of stylized facts due to this specific market, that is the electricity. So the scope of our work is to extend the investigation and modeling of the stochastic properties of electricity price growth rates beyond the first two conditional moments of their distribution. We based our approach on a 4-parameter flexible skewed generalized error distribution model, and specifically, we use the conditional mean and variance, the GARCH-M specification provided by Closton et al. At 1993, and the conditional asymmetry and same parameters related to the respective to skewness and kurtosis, the time-varying exponential specification, by a prior work conducted by Saba and Theodosiou. So what we did here, we merged our expertise in both the expertise in the financial markets, and my PhD is on the Hellenic Energy Exchange. So we merge this knowledge and we work on this interesting paper. So the novelty of our research is that the composition of the total price of risk implied by the GARCH-M in mean coefficient into its pure skewness and components, as in Theodosiou and Saba. So we applied this idea on the European Energy Exchange, the largest actually energy exchange in Europe, since it represents almost 70% of the total European electricity trading, both in spot and in the derivatives market. As you can see, this is a huge market, and we managed to gather data from this market. And another reason why we selected the specific market is because of the high penetration of renewable energy sources. It's an indicative example for our investigation. So moving on to provide you a kind of the theoretical concept and framework in terms of the electricity prices. The lack of stability resources makes electricity prices extremely sensitive to demand and supply shocks. And this, according to Koopman et al. Of their paper in 2012, there are 4 specific characteristics that we need to handle one by one and carefully. To begin with, seasonality in prices, mean reversion in electricity prices, jumps and spikes that are frequent as well, and volatility clustering. And there is a plethora of papers that focus on volatility clustering and use advanced econometric techniques. And here I just provide you a list of such papers that we have reviewed in order to move on to the next level and analyze the specific approach from our side. So the first problem that we met at the early stage of our research is how to deal with the negative prices. Negative prices are met in electricity markets. This is unusual in terms of economic theory, but these if you prefer, this peculiarity is usually met in electricity, in wholesale electricity prices. What does this mean? It means that buyers are getting paid to consume electricity from the consumers, the sellers. However, if producers are willing to accept negative prices, this means that it is less expensive for them to keep their power plants on and than to shut them down and to restart them later. So this happens for that reason due to the technical specifications of the power plants, and also this happens due to the increased penetration of renewable energy sources in the system. I provide you some information here. As you can see, in 2017, there for 166 hours, there were negative prices in the day-ahead market, and in the intraday market, there were 185 hours out of the 34 days. So according to DeVos, negative prices are a correct signal representing the system's scarcity of downward flexibility, but also at the same time, a result from a market distortion caused by a renewable support mechanism. So we had a lot of discussions on how to deal with that specific problems, and we have decided to randomly generate positive prices using a simple mean and standard deviation of hourly returns along with the latest available positive prices. Thanks to this approach, instead of, for example, omitting just the negative prices, we didn't want to take this path, but we wanted to keep them and modify them, the negative prices. And thanks to this approach, we keep price signals coming from those negative values. And at the same time, we also can move on with the empirical investigation. Next, and in line with prior research, electricity demand is heavily influenced by economic activities and weather conditions. So these two factors explain the main seasonal behavior of electricity prices. For that reason, we set specific dummy variables, and we have split our dataset in both analysis, day-to-day analysis and month-to-month analysis. As I will explain you in the next slide, I have the box plots. Here, just wait a second. These box plots, the information that we received from these box plots actually guide us on how to set those dummy variables and how to explore if there are any different specifications coming from the analysis of the different days and how we should focus on isolating the specific components. So for the researcher, for the colleague who is going to give us feedback on this, I know that it was a paper that with a lot of mathematical expressions, which you need to be super dedicated and focused in order to understand it. But as you can see, the distribution of equilibrium prices, there are a lot of formulas, mathematical formulas that we have used from prior research, though, of papers providing by Professor Theodosiou and Dr. Saba. And what we did here is that we implement those knowledge on electricity prices. And actually, our findings are quite robust, and we're very happy since we at this stage we are waiting for some feedback from the journal that we have sent the paper. So the distribution of electricity prices, what is interesting in this case, that we we managed to isolate it both upside and downside risk by using this specific technique of Professor Theodosiou. So, of course, I don't want you to bother with the formulas and all those notations that we use here, but using the previous formulas and substituting them to the above equations, we have the final conditional non-centered skewed generalized error distribution model. This is our model for electricity price growth rates. And we, of course, we need to mention here the asymmetry parameter, which is of great importance for the investigation of the main issue of our paper. And as you can see on the right-hand side of the slide, the relationship between the shape of the distribution and the tail and the asymmetry parameters is summarized. You can see with negatively skewed, asymmetric, positive skewed in terms of the distribution of the electricity price growth rates. Here is the specification of the conditional moments. It is, I don't want to focus more on the mathematical expressions, but I would like to give you the important outcomes coming from our research. And as you can imagine, volatility clustering occurs when large volatility shocks occur in asset prices and followed by large volatility shocks of smaller magnitude, but with random sign. So asymmetric volatility, on the other hand, occurs when large volatility shocks have a greater impact on volatility in downside than upside markets, and vice versa. Plethora of prior research have focused on this, and also, as I am going to present you later on, we also identify some important implications coming from our research as well. This is the model estimation, and moving on to the empirical results, I will stay a little bit at this slide and just guide you through what is going on with one. We denote the Sunday, and at the end, the 7 is the Saturday. And as you can see, in terms of mean, in terms of standard deviation, asymmetry parameter, skewness, kurtosis, and shape parameter, different days and different hours, as I'm going to show you later, provide us different information. So if, for example, if we zoom in on the first box plot, with this row, it is representing the mean, and the 75% is included in the box, and the relating the rest, 10% on above and below the box plot is indicating by this blue and the red line. The dots are the outliers. So we have done this analysis both in terms of daily and in terms of monthly. As you can see here, from 1 until 12, we set the different months. And by this analysis, we have set different dummy variables aiming to capture specific seasonal effects on our empirical model. So this technique guides us easily in order to move on set the correct dummies in our empirical approach. And these are the findings that we had. It is a complex methodology that we use, and it is based on different equations in terms of conditional variance on the left, conditional mode. Here I just provide you the tables, the findings, and later on I will stop and focus on the findings and just present you that. But for the one who is interested in our paper, all coefficients are significant at 1% level, unless otherwise noted, with 1 star and 2 stars representing statistical significance at 10 and 5% respectively, and the hashtag denotes statistically insignificant. So also the same holds for the asymmetry parameter, lambda, and the shape equation, K, and the skewness price of risk. So these are just the findings, and for the last 3 to 4 minutes, just give me the opportunity to present you our main findings. The tables before present the estimates of our model, and we have selected 4 different hours for each day. And these are 2 a.m., 8 a.m., 2 p.m., and 8 p.m. So in that way, we try to capture the various effects during the 24 hours of each day. Firstly, there are some findings that we identify in terms of the different hours per day, but I will focus on the conditional variance. The estimates for the parameters that account for the daily effects are significant, except from the base day period. And regarding the seasonal dimensions, all periods are significant, only at the prices recorded at AM.
5 minutes, Philip.
Okay.
You have 5 minutes.
Okay, so since I will just move on to the conclusions because it will take me some time to present you that. So what is what came out of this the novelty of our research? The main findings suggest that electricity price growth rates behave differently compared to financial or freight rates with past positive shocks. What happens here? Past positive shocks have have a greater impact on current volatility compared to the impact of negative shocks that of the same magnitude. So that is a main finding that we have. In addition, seasonality affects the time varying of moments of the distribution, which is more pronounced for the shaped parameter. Moreover, our model demonstrates the existence of mean reversion in daily growth rates of electricity prices, since correct electricity growth rates are never negatively predicted by their past values up to the 21st lag. Some policy implications arising from our study is that the ability of the flexible specification to model kurtosis, which is in turn helps to identify extreme events that occur frequently in electricity markets, offers the investors a tool to improve their investment profitability, which could be significantly jeopardized by the presence of such events. So currently, more and more investors try to hedge their portfolios due to the increased penetration of renewable energy sources into the system. By applying the proposed periodic GARTS-M model with conditional skewness and kurtosis, we assist to the understanding of price volatility in wholesale electricity markets and suggest a specific model that would be of use for policymakers, participants in derivative markets, and large energy consumers interested in hedging strategies. Our empirical findings in this article may have important consequences for the modeling and forecasting of functions beyond the first two conditional moments of spot prices for electricity. Finally, given the inefficiency of risk measures typically used in financial markets, our research explores tools aiming to guarantee the sustainability of components involved in electrical supply by separating extreme positive from extreme negative variations. And as a final comment, suggestions for future extensions are the investigation of strong interrelationship between prices and consumption, based on multivariate modeling approaches, or interaction among the various sources of electricity generation, along with the impact of price volatility from the day-ahead and intraday markets. So that was my presentation, and I'm here waiting for your comments.
Thank you very much. Now our discussant is Miriam Sosa Castro from Universidad Nacional Autónoma de México.
Yeah, thank you for the presentation. I want to thank the organizers. I think it's a really good event, even we are far, but we can connect by this technology. So also I want to thank the opportunity to comment this very nice paper. The summary, this paper analyzes the electricity price growth rates beyond their first two conditional moments, allowing for the impact of seasonality on their parameters. Two contributions, the decomposition of the price risk into its pure skewness components, and the development of a risk-neutral forecasting equation for electricity prices. I think that in general is a very interesting and well-written paper which assesses a key variable, electricity prices, analyzing four different time varying parameters: mean, variance, skewness, and shape. I really enjoyed reading it. Congratulations, and I am sure that this paper will be published in a well-ranked journal or book. And I think that maybe you can upload literature and include other methodologies in their literature review, such as artificial neural network, wavelets, or generalized additive models. I leave here a couple of suggestions. And also I think that maybe it's because it is your PhD thesis, I think, or a fraction of it. So the length, I think it's very large. So maybe you can divide the results of the monthly data and the daily data, and maybe you can have I don't know, two research, sorry. And I think that the 2.1 volatility clustering section could be shortened because I think that it's a very extensively analyzed topic in literature. So I think that maybe you can even remove, or you can put together 2.1, 2.2, and 2.3. I think that maybe you also, it's just a couple of typos that you have, like introduction. And I have I think that if you divide the results in a monthly and daily, maybe you can explore, or you can, I don't know, increase the analysis about the monthly data, because you have all the things about the daily data. So that are my main suggestions. I think that's a very good job.
Thank you, Miriam, for your comments. I will take a note
we
of
are
them, and
time.
thank you so much.
Thank you.
Yes. Very brief comment from my side. I think, yes, the paper is too long, but anyway, what I was thinking is you should think like for publishing this paper in some kind of operational research or engineering paper, not in a finance paper.
We have submitted at the Journal of Econometrics, so because it's includes this technique, so we hope for some good feedback.
Good luck.
Thank you.
Very good. Well, we can move on, and the next paper is Economic Policy Uncertainty Impact on Mexican Economic Activity and Stock and Currency Markets, a DCC approach. And then the authors are Miriam Sosa, myself, and Alejandra, who is my wife, who's in the room 3 as a discussant. But and then Ifigenia will be discussing this paper. Then Miriam, go ahead. You know the rules of the game. 18 minutes, please.
Okay. Okay, thank you, Dr. Ortiz. And thank you for the presentation. So, okay, the abstract is here. So this paper aims to analyze economic policy uncertainty as a key variable because it promotes or inhibits portfolio and direct investment decisions, impacting economic growth. So we examine the impact of local, I mean Mexican economic policy uncertainty and American economic policy uncertainty on economic and financial activity. In Mexico, we use monthly data during the period January 1996, September 2019. And we propose a dynamic conditional correlation analysis. And the motivation is that uncertainty is a complex concept and includes not only diverse dimensions, but also influences macroeconomic issues like economic growth, economic development, outcome, industrial production, etc. And also influences individual or microeconomic phenomena like firm performance and growth, asset allocation, and risk management decisions. Also, this concept is related to other financial topics like volatility or prices, for example. And according to Bloom, uncertainty is closely related to economic activity and tends to increase during recession periods and diminishes during economic booms. One of the most important and popular economic policy uncertainty proxies is the index estimated by Baker, Bloom, and Davis in 2016. It is public and you can download from their website, and is based on headline newspaper coverage and has been extensively employed to the effect of these variables on economic and financial factors. Our contribution is about the impact of EPU on Mexican variables, because research about this topic is almost nil. And we have just a couple of papers, but the closest is developed by Bush and Lopez Noria, and but they only address the EPU effects on Mexican exchange rate volatility. In this case, we are using or employing data for economic variables and also for financial variables. Our empirical evidence obtained in this research is of utmost importance to economic authorities, policymakers, risk managers, and investors. During the last years, above all, since the global financial crisis, literature about EPU impact has increased a lot. So we have some studies about the impact of this variable on economic growth, then EPU effects on financial variables such as stock prices, investor information asymmetry, and management disclosures, BTC or Bitcoin returns, financial stress, stock returns, and also about exchange rates. In the case of our research, closest literature is developed by Guo 2019, who analyzes the EPU impact on stock markets for China, Hong Kong, and the US, employing Box-Jenkins methodology and DCC model. We also have the Jiong, Bian, and Shen paper, who examine the time-varying correlation between policy uncertainty and Chinese stock returns, using also this approach, and Sun, who analyzes the impact of economic policy uncertainty in the US on stock market performance, and in Canada and Mexico, but they use time-varying ordinary least square regression. And this other research I previously mentioned. Our data, as I said, we have the EPU index, which includes newspaper archives and count the articles that contain one or more terms of three sets. E, from economics or economy. P, about regulations, central bank, army, war, Federal Reserve, and all the concepts related to political figures and institutions. And U, about uncertainty. They employ a regression method in this paper. EPU for Mexico and the US indexes are employed. It is because Mexico's economy and the US are very close, and we have for example, all our 80% of our trade is direct to that economy, and also some indicators or the US indicators lead our economy. So economic variables, we use General Economic Activity Index as proxy of the GDP, and industrial production. In financial variables, we have the stock market, the IPC index data, and currency market, fixed exchange rate, Mexican peso, US dollar rate. Here we have the graphic analysis or both two graphics, two figures. The first one is the Mexican economic policy uncertainty from January 1996 to September 2019. And it covers the free floating exchange rate regime period for Mexican peso, and also includes calm and crisis periods. So we have that in the first part of the period, the Mexican economic policy uncertainty is so much higher than in the second one. Then we have that this indicator is diminishes in an important way, and opposite to the American economic policy uncertainty index, which increased in this above all in the second part of our period. Here we have the descriptive statistics, and we test the stationarity of the series and also the arch effect in order to run the Garch model and then the dynamic conditional correlational model. Our methodology includes, as I mentioned, first the Garch 1-1 model for simplicity, and then we use the errors to run the DCC model expressed by this equation. We use this model because of the advantages. It's a parsimonious model which provides efficient estimates that exhibit time-variant correlational structures between variables. It has the ability to detect changes in the conditional correlation over time, and compared with other methodologies as rolling regression, offers a better fit in the estimation. Because in this case, the window's size is arbitrarily set, so we have the some effect known as ghost effect, characterized by disappearance of some important effects in the relations. DCC model allows to capture all the information and do not have this kind of problems. We have here the results of Garch 1-1 model. In all the cases, the parameters are statistically significant, and the alpha plus beta result is for almost all the series near to 1 and inferior. In the case of the EPU US index, is the only one case that it doesn't happen. But in the rest of the series, we don't have we have that characteristic. So and the values of beta signs that we have long memory in series. Then we have the results of the dynamic conditional correlation series model, sorry. And here we have that the theta 1 and theta 2 parameters are positive and lower than 1. And this condition evidences that the model is stable. And in the case of the Mexican uncertainty index, financial variables are significant. For the rest of the models, just one of these two thetas are significant. So, and the degrees of freedom results signs that we have heavy tails in the distribution. So the graphic results or the graphic analysis indicates that Mexican stock market is negatively correlated with the economic policy uncertainty. This sign could be explained due to higher uncertainty promotes capital outflows, which diminishes capital market investment. In the case of general activity index and industrial production, both are negatively correlated with policy uncertainty. And after the subprime crisis, above all. And in the case of exchange rate, is positively correlated with the economic policy uncertainty. And it is because when there is more uncertainty, so the Mexican peso depreciates, and we have to pay more Mexican pesos for each American dollars. So the results for the US EPU index evidence that Mexico's capital market is negative correlated with the US EPU index from 1996 to 2001. And then we have a period of positive correlation, and after 2015, correlation is negative again. Here we have that maybe we can see a substitution effect. So when the uncertainty in the American market increases, then we have positive effects in our stock market, because investors reallocated their capitals and change positions in the American market for a Mexican market. In the case of economic variables, we have a positive correlation with the US EPU index. Above all, after the subprime crisis, we also can talk about this substitution effect. And in the case of exchange rate, it's also positively correlated, but in thank you, in a lower level than with Mexican EPU. Our conclusions. Results indicate a statistically significant impact from the Mexican EPU on stock and exchange rate markets, but not in economic activity. EPU series behave more like a financial variable than an economic variable. And we have that this finding also could be explained due to financial markets characteristics such as high liquidity, fast absorption of news that cause continuous and fast changes, high sensitivity to diverse markets and variables, among others. And in the case of the good and service productions, we require technology, capital, and physical spaces, economic activity changes, and its adjusts are materialized in the long run. So our results are consistent with other research findings with these authors. And our empirical evidence reveals a market substitution effect between the US and Mexico stock markets and high vulnerability of Mexican peso to Mexican and US EPU changes. This research contributes new information to design new strategies for risk diversification, asset allocation, and the design of new hedging instruments based on EPU indexes. Thank you.
Bien, thank you very much. Now our discussion is Eugenia Georgiou from University of Nicosia. Please
Hello.
go ahead, Eugenia. 8 minutes, you know that.
Yeah. Okay, let me find. Can you see that?
Yes.
Okay, thanks. Okay, thank you. It was a very interesting paper. I have some observations. Okay. An overview first. You view the economic policy uncertainty as a key factor for economic activity and stock and currency market, as it promotes or inhibits portfolio and direct investment decision, which impacts economic growth, as you say. You examine the impact of local and American economic policy uncertainty on economic and financial activity in Mexico, and you employ monthly data. And during the period January 96, September 2019, you use DCC analysis, and you find that local Mexican economic policy uncertainty has significant impact on financial variables. But the American economic policy uncertainty does not have a significant impact on real and financial Mexican variables. As I said, I find your paper well motivated. It has a nice contribution, and it does fill up a gap in the literature, which is worth investigating. The choice of the model is an appropriate one, and it's also, of course, appropriately executed. I only have some suggestions. I don't know, maybe you have thought about them before and discussed them and rejected them, but I'm going to say them anyway. You say that you find that your results indicate a statistical significant impact on the stock and exchange rate markets, but not on economic activity. Here, I would suggest that maybe, like some colleagues did in another paper, they found that it was useful to use another proxy that maybe you could use in addition, maybe, and it's called the nighttime light, as it was used in this paper as an alternative method to measure non-registered economic activity. So maybe this is a complementary measure. The authors of this other study motivate the use of this proxy for Mexico. I think you're not going to be able to find the data for the whole span, but maybe even for just a fraction of your time period, maybe it would be useful if you use that as well. Also, you say that due to the goods and services production requires technology, capital, physical spaces, etc. So there is, it materialized in the long run. So maybe you could use lags in order to take into consideration this delay in the adjustment. And my last comment is that you also say at the end that you're going to look at for future research in maybe it's country specific. And I just noticed that there is a study, but it's about political uncertainty that does something that they examine this country specific thing. So these are my suggestions. I enjoyed reading your paper. Thank you very much for that.
Oh, thank you.
Thank you very much, Eugenia.
I hope you
Some
found
remarks, whatever, Miriam.
Oh yes, I think that I didn't know about the nighttime light. I think that it's a very good suggestion, because in Mexico we have a lot of informality and a lot of other activities that are not registered in the GDP or in the other index. And yes, I think that panel model could be a good approach to extend this research using, I think that more countries. And in the case of the lags, yes, I was thinking about to use vector autoregressive and DCC analysis to combine and to have a better results. Thank you so much.
Have you tried it? Have you already tried it?
No, it's my homework.
Okay.
Thank you.
Thank you. Thank you.
Muy bien, thank you very much. We are fine, running on time. And our next paper is an asymmetric gauge model of the relationship between Bitcoin returns, volatility, and volume. I think Ifigenia is going to present it. Please go ahead, Ifigenia.
Okay, I'm going to, okay, this.
Go ahead.
Okay.
18 minutes, you know that?
Yes, I know that, thank you. Okay, this is a paper that actually, it was made with it's co-authored with two of my colleagues here at the University of Nicosia. And actually we did that in 2017, as you can tell from the data set. It was another version of this paper was presented at the Multinational Finance Society, and we got good feedback. Actually, that's why we split the sample. Okay, so I'm in the meantime, this paper, since I sent it to this conference, has been published. I won't say unfortunately, I am saying it apologetically, but it's been published. So I'm presenting a published paper right now. Okay. Okay, this paper is about the relationship between Bitcoin trading volume, volatility, and returns. These things are important in markets like the Bitcoin market because a lot of people there use technical analysis.
Do you have a presentation?
You can see
PowerPoint presentation?
No.
You cannot see it.
No, we can see the discussant. We can see your presentation as discussant.
Oh, sorry.
I think you need to share another screen or share entire screen.
Let me see. Now you can see it.
Yes. Mm-hmm.
Okay, thank you. I don't know why it paused. Okay, and we also focus on the asymmetry, because one of our hypotheses is whether volatility increases more when there are unexpected increases in the returns of Bitcoin, that is what we call good news, than it does to decreases in return. So, okay, as you know, the Bitcoin trading started in July 2010, and it started with its volume by then was like 5 cents of the dollar, and it continued until 2013. That's when it took off because of the investors lost confidence in the banking system, and because also related to that, more retailers started accepting Bitcoin back then. Of course, it was volatile. It seemed to be volatile since then, but it had a big dive in 2014 when Mt. Gox, one of the main exchanges of Bitcoin, was hacked and people lost trust in it. And then again, it had a big it had a big takeoff again in April 2017 when the Japanese government passed a law that recognized Bitcoin as a legal payment method. Okay. A lot of people and researchers and so on are talking about the volatility of Bitcoin, and that's the focus of the paper. And they said that the volatility is greatly higher than all the currencies that they know. It's even higher than the volatilities of currencies of least developed countries, and higher than most of the volatilities of cryptocurrencies. And actually, this volatility is mentioned as the main reason why you cannot consider Bitcoin as a currency. And what we were looking at is that maybe that was because of the low volume that if you compare it with the volume, we're going to see that later on this same diagram, because the trading volume seemed to actually follow the pricing history of Bitcoin. So our hypothesis, this is our hypothesis. The first hypothesis is simply whether Bitcoin's returns are indeed more volatile compared to other currencies, or is it because we see this volatility because of the low volume of transactions? Also, our second hypothesis is whether Bitcoin volatility and Bitcoin volume are positively related during what we are going to call as the euphoric period. We split the sample in 4 time periods. We have the period before the 2013, when almost a lot of people didn't know Bitcoin back then. And then if you remember 2013, it took off until the beginning of 2013, until the Mount Gox hack. The third period is between that hack and before the Japanese legislation. And the fourth period is after the Japanese legislation. So the euphoric period we are referring to is after 2013 and before the hack. We say that maybe volatility and volume are positively related, and we base this on several theories. First, the direction of the relationship between volume and volatility is not, as you know, very straightforward in the literature. From one point of view, a higher trading volume can just simply mean higher liquidity of the asset in question. And this situation, the higher liquidity, could make it easier for the investors to get rid of the asset more easily. And this could increase the trading of the asset, the trading and the volatility. Another thing that the higher trading volume means is that it could draw the public's attention to the asset, and this will trigger additional trading. This could be characterized as noise trading. Our third hypothesis is that Bitcoin returns and trading volume are positively related, and we base this as the increased trade volume creates a return premium according to previous studies. Also, as we said before, trading volume can be viewed as a measure of liquidity, which is significantly related to future returns according to previous research. And also higher volume means increased attention to the asset. And our fourth hypothesis is about the asymmetry. So we hypothesize that an unexpected rise in Bitcoin returns is expected to increase Bitcoin volatility more than an unexpected decrease of the same magnitude during the euphoric period between the beginning of 2013 and the closing of Mt. Gox exchange. Is whether this reaction, the volatility, the reaction of the volatility to the good or bad news is symmetric or not. A lot of studies find that stocks have what is called, as you know, leverage effect, which is that the market, the volatility reacts more to bad news. This is when the news are bad versus when the news are good. And for Bitcoin, we hypothesize the opposite, which has been also observed in markets that are characterized as speculative markets. And for Bitcoin, another reason we hypothesize that the opposite will happen, that is, we expect to see that the euphoric buying is stronger than panic selling in the Bitcoin market is that a lot of the investors in Bitcoin, specifically during that period, those periods we are examining, were buying and holding Bitcoin because of their ideology. They believe they were part of a revolution, according to one study that examined the motives of Bitcoin investors back then. So these are our hypotheses. For methodology, for the first hypothesis, we are just using descriptive statistics, and we compare the raw versus returns divided by volume, and these are the variables that we're going to use. I'm going to show that in the results later. For the second hypothesis, we use an Igarch model that includes the natural logarithm of the volume variable in the specification of the conditional variance as multiplicative heteroscedasticity. For the third hypothesis, we include volume as a regressor in the mean equation of the Igarch model. And for the fourth hypothesis, we use the Igarch model, which is an asymmetric Garch model that can capture this factor. These are our models and the explanation here of the variables. The data we used was from these sources that you can see here, and here you can see the use of the word other is questionable, currencies here. And let me just get to the result. Here you can see the daily change in the Bitcoin exchange rate measured against the US dollar. So this is the volatility. And also when we compare the volatility of Bitcoin with the other currencies, we see that it's very high. But then when we use the adjusted return to measure the volatility, we see that it stabilizes. So the first hypothesis is rejected. And these are the results of these are the Igarch results. As you can see, in all periods, the Arch and Garch terms are highly significant. In the periods that are follow the Mt. Gox exchange hack and closing, the Garch term dominates the Arch term, which shows that the volatility of Bitcoin is highly persistent then. Then the coefficient lambda here, which is used to examine hypothesis 2, is positive and statistically significant in all periods that we check, except the period before the 2013. So hypothesis 2, that Bitcoin volatility and Bitcoin volume are related, cannot be rejected during the three last periods under study. The coefficient B1, which is used to check hypothesis 3, so this is the coefficient of the natural logarithm of the volume of trades of the of T-1. We see that it's positive and statistically significant in the first 2 time periods under study, that they are ending before the hack of the Mt. Gox exchange. So the coefficient is positive, but it's insignificant after the hacking of the Mt. Cox exchange. And if we focus now on the asymmetry term gamma, which is used to check hypothesis 4, although it's relatively small and it's not dominating the arch effect, the alpha, it is positive and statistically significant during the time period of the beginning of 2013 up to the time of the Mt. Gox hack, the so-called euphoric period. And this shows that volatility increases more when there are unexpected increases in returns than it does when there are decreases in returns during that euphoric period. And to conclude, so hypothesis 1 was rejected. We saw that when we use the adjusted returns to calculate the volatility, we saw that the reason that Bitcoin volatility appeared to be high in previous studies was because of the low volume of trade. Hypothesis 2 was not rejected. As we observed that lagged volume and volatility are positively and significantly related after the beginning of 2013, but before that, they were not related, these two variables. Possible explanation is the increased attention that the Bitcoin started receiving in 2013, which in turn triggered additional trading, and this is in accordance with previous studies about other assets. The third hypothesis is also not rejected. We find that volume and returns are positively and significantly related before the Mt. Gox exchange hack and its closing down in in the beginning of 2014. This again could be due to the high volume return premium, which is in turn consistent with the idea that shocks in the trading activity of an asset have an effect on its visibility, and subsequently this can lead to higher demand and higher prices for this asset. And finally, our fourth hypothesis is not rejected either, because we see that there is an asymmetry in the response of Bitcoin's price volatility to good versus bad news. We observe an anti-leverage effect. So that means an unexpected rise in returns could increase volatility more than an unexpected decrease of the same magnitude during the euphoric period between the beginning of 2013 up to the exchange hack. So that means that maybe it's because of this ideological motivation behind the Bitcoin. So when there were good news, the investors in Bitcoin would feel like their beliefs were confirmed and they will be very happy about it. But when the news were bad, they wouldn't rush into selling their asset because they believed in it. So that's it from me. Thank you for your attention.
Thank you very much, Ifigenia. Well, I have a surprise for all of you. As you know, in Mexico City, and especially our own university, our ladies, the students, female students, they have been on strikes demanding women's rights.
Good for them.
And in this session, we also have the same. We have Beatriz Valadez and Miriam Sosa. So they strike against me, and they told me that I have to review your paper. So I'll be reviewing your paper.
Okay,
but
thank you.
If I don't do a good job, you can pull my ear. So let me try to share my.
Thank you very much for the
There is the presentation. And then there are going to be my comments. I'm not going to stress the econometric part because that is, I would say, the smooth, except for important comment. I will do that later. But anyway, I find your paper very interesting, well thought, and well structured. In a nutshell, the work by you, Sapurik and Kokinaki, provide an enhancing understanding on the relationship among three important Bitcoin variables: returns, volume, and volatility. You point out yourself this in the implications of your work. I also would like to stress that you provide us with evidence that indicated that Bitcoin is not as volatile as commonly believed.
Sorry,
Test for
Doctor.
hypothesis and relating volatility to volume, and the volatility measures lowers a lot when and tends to certain stability when volume of Bitcoin trade is taken into consideration. However, I would like to make some observations which I hope would make you to revise and strengthen your paper, both to submit it for publication either as a chapter of a book devoted to Bitcoin issues or else submitted to a journal on financial econometrics. First, I think your study covers the period 2013-2017, which, as you pointed out in your presentation, you divided it into 4 periods, taking as reference 1, the loss of public confidence in the traditional banking system of 2013, when Bitcoin started to gain mainstream attention. 2, the main God's Bitcoin exchange hack in early 2013 and the exchange subsequent shutdown. And 3, the introduction of Bitcoin registration in Japan in April 2017. These subdivisions, these partitions need to be fully justified. For me, the way I read it, these subdivisions are a bit fuzzy. First, concerning the loss of confidence in the banking system in 2013, you consider that was affected by low confidence in the banking system due to the uncertain and crisis-prone European markets and the bail of the Cyprus banks. I think this will be true if the largest share of Bitcoin trade took place in Europe at the time, which I don't think that was true. However, at least in the US, important also for Bitcoin trades, most studies in financial analysis that year pointed out that there was a recovery of confidence on banking after a critical loss during the Great Recession. In fact, according to a survey by Ernst & Young in January 2013, that survey mentioned that since the end of 2012 and then to 2013, confidence was rising. Moreover, a Gallup retail banking study by September of 2013 revealed that the confidence was growing, was still low compared with previous years before the crisis, but confidence confidence increases from 21% to 26%. Regarding the MOX hacking problem, as you know, I'm sorry. Yeah, however, regarding the MOX hacking problem, as you know, this exchange was had that problem in early 2014. Loss was of about 740,000 bitcoins, equivalent to then to 4,000 and 1,000 euros at the time, and over $3 billion dollars in 2017 prices. First, it is important to mention that this problem was already present in 2013, the loss of coins, and hawking, and in minor amounts in 2011. Second, many legal problems in Japan and the United States have followed, and there are still many problems and unknowns which impacted other exchanges. In fact, well, finally, in relation to the Japanese Bitcoin legislation, although it's an important event, why Japanese legislation considered more gold why you still give it to such importance when Mount Gold went bankrupt in 2014, and trade, of course, fell down in Japan. Additionally, there were, during the sample period, other events related to Bitcoin prohibitions and opening up to Bitcoin trade in some countries like China and the United States, which most likely affected the volume of Bitcoin trade. For instance, and let me point out that this is just I got this information, this and the Chinese information from Wikipedia. I was looking for formal research, but I couldn't find it. But still, this is valid. In the United States, the US Treasury classified Bitcoin as a convertible, decentralized virtual currency in 2013, while the Commodity Futures Trading Commission classified Bitcoin as a commodity in September 2015. Also, Bitcoin is taxed there in the United States as property. Regarding China, financial institutions then are not allowed to facilitate Bitcoin transactions. Regulation prohibits financial firms holding or trading cryptocurrencies. On December 2013, the Bank of China made its first step in regulating Bitcoin by forbidding financial institutions from handling Bitcoin transactions, which should have affected trade volume. Similar, on April 2014, that bank ordered commercial banks and paying companies to close Bitcoin trading accounts in 2 weeks. Cryptocurrency exchanges or trading platforms were effectively banned by regulation in September 2015, with 117 platforms closing down by July 2018. In short, there were some overlaps or some other events which affect the consistency of the sub-periods of your analysis. Second, you concentrate in Bitcoins and compare it with the behavior of other currencies and gold. This is valid, but also suggests a portfolio approach. Otherwise, there should be any interest on that. A stronger consistent balance analysis should include other cryptocurrencies, particularly considering hypothesis 1. Also, please consider that trade in Bitcoins might decrease due to a substitution effect, increased full charges in other currencies. Third, in your introduction, you acknowledge the 3 reasons for you partitioning your sample in 4 subperiods. It looks as if you are employing those subsets to test all 4 hypotheses you present, which is not true. This is only a matter of style, but it must be clarified, because hypothesis 1, you don't use these subsets. And as I said, it's a matter of style. Fourth, dealing again with the subdivision of the sample. Your subdivision in subperiods to some extent is intuitive. It's based on the graph you show us about the volume trends of Bitcoin trading. I think that applying structural breaks could help to confirm the relevance of the points originally identified by you, or else it could lead you to find other points, other subsets. Furthermore, you use EGARCH model, assuming it is based to test Bitcoin volatility and asymmetry, which is true, but it tells concerning EGARCH modeling must be employed to some specific criteria, because there are several models which deal with asymmetry in the EGARCH modeling. APARCH, ACC, ACGARCH, TGARCH, and so forth. Check the works by Katsiampa 2017, which you cite, and Sosa, Ortiz, and Cabello, present in this conference, to strengthen your session. We will be happy to share that research with you.
Thank you very much. Could you also send me this document with...
Let me finish then.
Sorry.
Fifth, for further research, I suggest also to try to some other alternative models to test volatility of financial assets, now also applied to cryptocurrencies. High frequency data are becoming very frequent now. Access to such kind of information is not easy to get, or else it's too expensive. That's why here Sosa, Ortiz, and Cabello, we haven't dealt with that problem yet. But still, an alternative, which I recommend, is using range models, basically intraday for beginning, minimum, maximum, and closing prices for each individual daily observation. Please check the literature about it. Finally, some recent works you should revise. Here is a work by 2019 by Alborg, Molnar, and De Vries in Finance Research Letters. A paper by Burry, Ken, Lowe, and Lucas in Finance Research Letters. also from 1920. Eros, McCarthy, Uckworth, and Wolf, 2019, from the Research in International Business and Finance. The work by Kat Ciampa, which we already mentioned, and you have it in your own work. The last work I mentioned by Sosa, Ortiz, and Cabello, which we will be happy to share with you in case you consider okay. No?
Yes,
There is
please.
the paper by Eros that says the intraday dynamics of Bitcoin. I think it is in this paper that we'll find it interesting because they make a good observation that when by the end of the day, trading is low. So that is all what I have to say about your paper. More than anything, is food for thought, and I hope it's useful for you, and it helps you to revise and publish your paper soon. Thank you
very much. Could you please send me, I will send you my email to send me.
I have your email. We'll have your email.
You have it. Thank you. Actually, this paper, in the meantime, it got published, but your analysis gave me good ideas for new papers. So thank you about this. And also this with the event, we are already working with 2 co-authors to take into consideration more events. Thank you very much. It's been very, very helpful, and thank you for taking the time.
Thank you very much to you.
Thank you very much.
And we're happy to meet you virtually, but okay.
Maybe next year we will all meet at the dance.
Well, we had a meeting for the multinational conference in Cyprus. We have a meeting in Thessaloniki, and we have many good memories from, of course, those meetings.
Nice conference with nice people.
And good food, good friends. So we will continue with that, and we hope to go back then to Cyprus, Nicosia, Thessaloniki, and so forth.
I hope
and
that.
Thank you very much for your
presentation.
Very much.
Thank you.
Now is the time for our last paper, which I am co-author. As a brief introduction, I would have to say this paper is back to the principles. It's not a super sophisticated paper like the previous papers we had in this session or in the other sessions. It's back to have some practical applications using value at risk. Why? Because to some extent, Beatriz was worked in the Mexican Securities Banking and Securities Commission. And of course, they have been always interested in practical issues about control of risk. And that's why she got inspired in using VAR for this paper. So go ahead, Beatriz. 18 minutes.
For the presentation, Doctor. Good morning, everybody. Good afternoon. Well, let's start. Let me share the presentation, Doctor, please. Yes, well, let's start it. This work investigates hedging performance on 2 futures contracts. The peso dollar traded in the Mexican derivatives market MEXER and the dollar peso traded in Chicago Mercantile Exchange CME. We apply value at risk unexpected shortfall enhanced by catch 1-1 modeling. The left and right tiles of the future return series are examined for both short and long positions. The period analyzed comprises October 2016 to June 2017. Partitioned in 3 subperiods, results obtained for each market are compared, and finally, their statistical validity is tested applying Kupiec backtesting. Overall, hedging in CMA is more effective, albeit the mixture outperforms that market occasionally. The globalization has led during the last 5 decades to a significant growth in trade, real and portfolio investments, which in turn have been accompanied with a greater use of currencies transactions, albeit dominated by the dollar vis-a-vis other national currencies. This article addresses this issue using a contrast analysis with 2 hedging performance metrics, calculating VAR and expected shortfall, incorporating arch modeling. Additionally, our methodology integrates the trading position, distinguishing between downside and upward risk. Our purpose and hypothesis? Well, our purpose is to analyze, contrast, and determine which metric under the dual gauge yields is better and statistically robust estimates about the currency coverage with futures, comparing the empirical evidence for VAR and ES. Our hypothesis is that it is possible to obtain greater accuracy estimating potential losses when applying the ES under a gauge approach with different levels of confidence, 90%, 95%, 97%, and 5%, and 99%. Our contribution. Well, extended the financial literature by examining the performance of futures in 2 different markets offering a similar subject. Second, presenting alternative tools to aid market players in their decisions concerning the analysis and estimation of currency hedging with futures of 2 economies linked by trade and financial activities facing significant economic financial challenge. And the third, it's an accessible and practical model. We are presenting practical alternative tools to aid market players in their decisions concerning the analysis and estimation of currency coverage with futures. About the related research, the literature on exchange rate coverage is extensive, but has almost limited itself to determining the optimal hedge ratio. It indicates that the literature using to VAR and ES is smaller, and the existing one does not cover emerging economy countries. And earlier works must be mentioned is Burns in 2002 compares value at risk estimates using univariate gauge models. His evidence shows that gauge estimates are superior to the other methods in terms of the accuracy and coherence. Mason and Janavi, they employ value at risk to assess risk and deliver practical approaches to manage foreign exchange trading risk exposures. Nadaraja finds some limitations on, and he makes value at risk and decides to apply expected shortfall to overcome them. He makes an important contribution reviewing estimation methods of over 140 reference about for expected shortfall. There is recent literature must be mentioned too. As Reboredo, Rivera Castro, and Ugolain, they extend the analysis of foreign exchange risk examining downside and outside risk spillover from exchange rates to stock prices and vice versa for a set of emerging economies. Su and Hong in 2018, they used 7 bivariate gauge models to forecast the out of tempo VAR in 21 stock portfolios on 7 currency stocks portfolios with 3-weight combination. Also related to recent trends in VAR and EOS research, as Patton, Siegel, and Chen, in 2019 made use of contemporary statistical decision theory to surmount the problem for years by jointly modeling yes and bar using GARCH or rolling, excuse me, or rolling window models. Megan Taylor gives you the information about the distribution del behavior on 5 stock indexes returns, as well as concerning 5 individual corporations returns employing bar and EOS. But these models are sophisticated and therefore not much applied. Well, concerning Latin America and Mexico, the literature reports few studies. None were related with exchange rate hedging. The research from Reyes and Ortiz in 2015 used M-BAR's methodology, value at risk models, and multivariate GARCH models for the national portfolios from the NAFTA countries, Canada, United States, and Mexico. The methodology and empirical analysis. Well, we have the partitions. Our analysis covers a sample from 2016 to 2017, partitioned in 3 subperiods, as we can see on the table. First subperiod ex-ante covers October to December 2016, which analyzes the behavior of the model in a lapse prior to the stress of exchange rates. The second subperiod examines the problem during a volatility turmoil affecting exchange rates from January to March 2017. The last third period, ex-post period, comprises April to June 2017, showing the details of these periods in the table. Our analysis covers a sample from 26 to 2017 partition. Graphs and correlograms. The historical behavior of spot of future prices and logarithmic returns of both the Mexican and CME. At first glance, one could believe that the series are non-stationary, the mean being a function of time and non-constant variance. However, observing the corresponding correlograms of the series, it can be inferred that if that series are stationary, the correlogram decays as key increases, key equals number of lags, which is not present in the case of non-stationary series. The statistics of the false sample. It can be observed that mean values for both markets and both future prices in the returns are positive regarding the price series. The standard deviation in there is greater than CME. The logarithmic return series reveal the opposite behavior. Kurtosi's interval highlights the fact that all return series are high-peaked. Asymmetry is concerned, all series are asymmetrics and skewed to the left. Harkevera statistics confirms that all series are not normal. Augmenting Dickey-Fuller unit trust test, it is found that the row series are non-stationary, whereas the log return series are stationary. This is important from hedging aspect. As a non-stationary series, this may lead to spurious regression that therefore cancel estimation of hedge. Well, we apply another test, just like the test ARCH and ARCH 1.1 and ARCH LM1. Where carry out whose result from the information criteria of Akaike, Schwartz, and Hanna, it's observed that these are the ones corresponding to the GARCH test 1-to-1. Consequently, this strengthens the justification for using this model. The normality test, Harkevera, to calculate the skewness and kurtosis of the residuals. The unit trust test, the stationary of this stochastic process is analyzed, the test student test to strengthen the research tools, and ARCH Lagrange method. This test is carried out in order to strengthen the stereostochastic test in the series and support the use of GARCH model. Well, finally, we are in metrics of risks applied. These metrics we choose are bar and ES. Bar was chosen because it determines the maximum size of losses associated with hedging strategies, and because it increases the use of a risk measure, both for internal risk management models and for regulatory reasons. It is the maximum expected loss or worst loss over a target time horizon within a given confidence interval, measured in a reference currency of the portfolio's expected profit and loss incorporating all possible information regarding market behavior in the future and the present composition of the portfolio. And since VAR does not count for losses beyond the 100 minus X percentile, the deficiency is addressed by estimating an additional performance metric expected shortfall. This metric measures the mean loss conditioned on the fact that the VAR has been exceeded. The ES is used as a hedging performance metric because it provides hedge with an estimator not only of the probability of loss, but also of the magnitude of the expected loss. Thus, in order to have a point of comparison between these two metrics, we arrived at the following expression for the calculation of these metrics under the GARCH approach. Here are bar for bar G under GARCH approach, on ES under GARCH approach. Bar G, ESG. Well,
5 minutes.
Thank you.
Please.
Expressing the results in practical way, the markets, that makes it easier to contrast evaluating both for bar and for the ES as a reduction percentage of the hedged portfolio with the unhedged portfolio. Well, the results. The greatest protection for the second short position during the turbulence period is attained with ESG at 95% confidence level, with result of 95 and 48 represents the percentage reduction of the expected shortfall in the covered position compared to the uncovered position. The differences in performance between metrics. The best sample performance metrics is that of the 95% ESG confidence level resulting 97 and 78, while the worst coverage performance corresponds to the bar G with 68 and 49. This represents a performance differential of 31%. Well, backtesting. The number of failures of our estimates are well below the expected number of failures according to the parameters set out in copied table. This is the table. Therefore, our empirical evidence is statistical robust. The models applied are strong, and the most appropriate metrics to hedge against exchange rate can be chosen for either ex-ante amide and exposed volatility periods. Overall results. Results by period based on the expected potential loss. 3 of the 24, we found more rigorous results in the Mexican market. A portfolio hedge of 97 and 7% in table 4 is the one that reduces risk the most. In relation to the short position, most likely the results reported are due to the changes in volatility. Considering the long position, it is observed that in 10 out of the 12 cases, considering different alphas, it is bar G at 99% confidence level, which gives the best risk coverage. As for the MXDR, the results observed with ESG are somewhat stricter. As for the Chicago, also in MXDR, there are stricter results applying ES risk. And finally, our conclusions. The results of this work suggest that hedgers are interested in fat tail distributions and likely to benefit using hedging performance measures. The difference in risk forecasting between the two markets can be attributed to differences in market depth, traded volume, contract size, and market performance, as well as institutional factors such as the currency used, to the purchase of future lots in each market. And finally, further research is needed for the case of currency hedging in emerging countries whose currencies are subject to sharp volatility patterns, which can contribute to the advance of their financial system. Mexico particularly needs this type of research. Well, thank you very much for your attention. All comments and observations are welcome to these emails. Thank you.
Thank you very much, Beatriz. Ifigenia, you have the floor now, right? No, pardon.
Actually, Professor Cosmido was up to present feedback on this paper, but I asked her to discuss on this paper because I work on a similar one with using value at risk and expected shortfall. So if you don't mind to...
No, we don't mind. We're happy to have you come.
I got scared for a minute. I thought I had work.
Be hard on us. You have, you know, to my students, I have some ways to induce them to work hard. One is pulling the ear. Another is this, they call, I don't know how they call in Greece. And another is PTC, which Beatriz or Miriam can translate it into English.
Kicking the ass.
What does that mean
in English? Is kicking the ass in your ass.
Okay.
Kicking your ass. So,
my ass,
Miriam
yeah.
and maybe they have not got to that. And Miriam, well, she's...
From my side, I will be soft, of course, because I really enjoyed reading this paper.
Miriam is is already a professor. She was my student. It's the best student I ever had.
Yeah,
and
you are.
She's working on that. I think that is the way we work. Fortunately, nice. with work and some fun.
Yeah. So combination.
Please, Filipos, go ahead.
Can I have the access to share my screen? Because I think that Beatriz is still sharing her screen, so I cannot share mine.
Could you please stop sharing your screen, Beatriz?
Yes.
Okay.
Okay.
Now you can see mine, right?
Yes.
Yes.
Okay. Yes, as I said earlier, I choose to discuss on your paper because I really find interesting. Not, you know, it's the same methodology that I use also in my research. So that's why I'm here today to talk about your paper and a little bit an overview of the scope of work is to investigate the hedging performance of two future contracts, the peso dollar traded in the Mexican derivatives market and the dollar peso traded in the Chicago Mercantile Exchange. So the methodology is, I suppose, common to most of us. The value at risk, the expected shortfall, the guards 1-1, and the authors use it in 4 different confidence levels. So the analysis is in both short and long positions. The period under examination is from October 2016 until June 2017. The robustness test is a QPEC backtesting. And in terms of the empirical findings, the hedging in Chicago Mercantile Exchange outperforms the Mexican derivatives market. So, as I told you in the beginning, I really enjoyed reading it, and it is well written, and I think it is as you know already, it really needs some carrots in order to go into such a an approach, because the reviewer is going to be well familiar with that, and you cannot, hide something, and everything is crystal clear. And in your approach, I really like it, because you cover almost that I expected to see. The introduction is smooth and well written on the subject under examination. The paper, of course, is based on previous examination of the same authors, but the novelty of the study is properly presented, the incorporation of Gart's modeling, and the distinction between downside and upside risk. The purpose of the study is clear, hence, and since it contributing to the prior literature, and this point is stated as well. So my comments here is that I would expect to find the citations of the source paper, and I would include it in the introduction, and additional information is needed describing the overall market liquidity and the rationale for the selection of the specific future contracts. So in terms of literature review, quite small comments here. Of course, there is some space for some expressional improvements. The review of prior or real literature in chronological order is definitely an advantage of this section. Another pleasant surprise was the presentation of a summary in terms of the literature review. However, this is not obligatory, and a couple of paragraphs have different font size. I'm sure that you are going to pay attention and be careful in this, because reviewers are very strict on that. Data. I have some questions here. I would merge chapter 3 and chapter 4 as data and methodology only, and I would like some more information in terms of data frequency, and I have some issues with the magnitude of the paragraphs. Some paragraphs are too long, some are shorter, and this is quite something like an obstacle for the reader. But in terms of the methodology, all the tests, as also you mentioned earlier, you used all the tests, but please check an expressional issue in section 3.1 in the second paragraph, and I would also like to see the tables in the main text, and some information regarding stationarity and normality test could be excluded from the study, since experienced readers are already familiar with the above information. The same holds also for VA, value at risk and expected shortfall. I would merge those sections into a smaller chapter with smaller magnitude. Chapters 4.3 and 4.4 are properly discussed. In terms of empirical analysis, figures 1 and 2 should be enlarged statistics, and the values are not easy to read. As I can see, the updated version that you presented to us, Beatrice, are way improved, and I really enjoyed your presentation, and since you changed the tables. Some results, I would prefer if I see the results in bullet points. The results are robust, but the part with possible explanations needs improvement. Conclusions, a proper structure in general and presentation of the results. Further research is included. However, research limitations and restrictions are not included in the version that you sent me. And any other, I was searching for any other policy implications, if available, and the reference list should follow the same format and style for all throughout the references. So that were my comments, and I wish you good luck with this paper.
Thank you very, very much. Yes, there is a lot of room to improve this research, in general, this line of research. And Beatrice, she's taking practical approaches, but she's doing well.
Yes, definitely.
Thank you very much.
I wish you the best of luck for the future.
Thank you.
When are we going to have another meeting in Greece, Peter?
Whenever
No.
Edgar.
I hope that we have our meeting in Poland next year.
I
What we
hope
need
so.
badly is that they discover the vaccine so that the problem gets away forever.
Well,
Everybody can take. You know how I am, look. This is your fault, Peter.
my fault?
Yes.
You put
I've
the,
been confined over 100
I know you
days.
put the, you left the beer because you don't want the coronavirus to approach you. You know, you put the buffer.
Yeah, I want to scare. I want to scare it.
No, no, you're great. You see, I stayed until the end, although I've been here from morning until now, without lunch, without dinner.
Because
on
our
my boot.
presentations were so interesting.
And my friends from Mexico, as well as Iphigenia too, who likes nice red wine.
We should
Yes.
have also a reception, virtual reception, and everyone has their one.
Virtual reception, you're absolutely right.
I have next time 2 or 3 more of our Mexican guys that have come to the meetings. They re-engage in our meetings. This time, you know, with all the changes, it was difficult. For me, as I told you, my university was on a strike. Several schools were closed by women, demanding women's rights. So I had to use, for instance, the Zoom and all of that, even before the COVID crisis comes along.
Well,
And